Some of the wealthiest people in the United States are those who made their money or saved their money in real estate. Today we'll talk about how they never pay taxes, how they improve their properties, how they defer gain. You will find out everything you need to know about real estate investing 101. Tax consequences of purchasing real estate. There is a lot of misconception about it. Let's separate primary residence and investment properties and talk about it real quick. My name is Alexey. Thank you for tuning in. So, as we all know, if you buy a home as a primary residence and then later times come to sell it, if you're a single person, $250,000 of gain. Gain is difference between purchase price and sale price is not taxable. If you're married and filing jointly, then $500,000 of that gain is not taxable. Not taxable means you get that money tax-free. It just goes straight into your checking account. Now, we also get the benefit of mortgage interest tax write-off, and this is where the complications start. If you are living in a primary residence, you can write off interest from your taxes for the mortgage of up to $750,000. Here is the catch, and this is where people go into trouble. If it's an investment property, then there is no limit. How would somebody buy a hotel room, a large office building, if they can't write off the interest? If this is an investment property, then you can deduct much more than just your interest, but there is no limit on the interest. So if it's a home that's worth $4 million, you can write off the entire mortgage amount. If it is an investment property, then, and you want to sell it, obviously you can't get the benefit of $500,000 tax-free. But there is another thing called IRS Section 1031. How it works. If you sell a property that is an investment and then you replace it for another one that is like kind, which means it also serves the investment purpose, then you postpone that tax gain. In other words, the entire sale price goes towards the purchase of a new property. There are some rules you have to follow, and we'll talk about them in a minute. But the idea is rich people or wealthy people, people who deal with real estate, never pay their taxes, or they seldom pay taxes. And when they die, the tax consequence gets wiped out. And we'll talk about it in a second. Remember how in the beginning of the conversation we were comparing principal residence versus investment property. People ask me all the time, hey Alexey, well, what if I want to move into my investment property? Does it mean after a certain amount of time I will not have to pay taxes when I sell it and I will get my $500,000 off? Hear me out, and this is how it works. So if you want to take advantage of the $500,000 or $250,000 for single taxpayers, you have to live in the property for 2 out of the last 5 years. So technically speaking, you can rent it out for 3 years, then live in it for 2 years, and then sell it. However, if you had tax consequences already in place in that property, for example, if it was a rental for many years, and then you moved in and converted it into a primary residence, it means the tax consequences will be proportionate to the amount of time you spend in the home. And this is not a tax advice. Please consult with a tax attorney, because these laws do change all the time. As far as I know, the way it works is as follows. Say you rented the home for 2 years, and that's something you exchange into from prior properties. Then you move in for 8 years, and out of the total of 10 years of ownership, 8 years you lived there yourself, and 2 years you rented it out. Your total tax gain will be divided by 10 parts, where 2 parts will be taxable and 8 parts will be not taxable. And this is how you convert a property from the exchange into primary residence. So, 1031 exchange. When we sell a property and we buy a like-kind property, then the tax is deferred. What does it mean? Let's take a real example, lifetime example, and even make it a little more complicated, because I will show you how a profitable property becomes unprofitable over time. So I bought a house in San Jose, California in 2011 for $240,000. Right now it's worth about 1.2 mil. So in 13 years of ownership, I have made a profit of about $1 million just by the fact of owning it. If I were to sell it right away, then I will have to pay taxes, long-term capital gain tax on that $1 million price difference. Even more than that, I will have to pay back amortization that I took over the years of ownership. That will increase my tax liability to approximately $1,050,000. So one way to not pay that taxes is sell the property for 1.2 mil and then buy something else that costs at least the same amount of money. So new property has to cost the same. It can be two different properties at 600 each, but the total cost has to be at least 1.2. How does it work? Once I sell my house, I have 45 days to designate what I'm gonna buy next, and then I have another 180 days to close escrow. If I screw up the deadlines, if I'm late somewhere, then the tax consequences becomes due. It is super risky, obviously, because I'm looking at $400,000 in taxes. One way to avoid it, and one way investors deal with it, is find a property that we want to exchange into, and then find a buyer for the first home and close both transactions at the same time. And that's a cheat sheet not many people are aware of. If I were to find a buyer, say somebody who wants to pay 1.2, 1.3 mil for my home, I would come to him and say, hey, dear buyer, or her, I will give you a $50,000 discount from the purchase price, but I'm gonna ask you to wait for a longer escrow until I find something cool to exchange into. And then I go out and I start looking for a home. I make an offer subject to the sale of the first one, and I close both transactions at the same time. And this is how it's done. This is why you need experienced people on your side, because tax consequences can be enormous if you don't follow the rules, if you make a mistake, or if one of the agents on one end does something wrong. Tune in for more.